I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. Hello, good to see you today. All right, let's not waste time. Let's be fast about it. Okay. All right, so we've been having classes on group balance sheet or consolidated balance sheet. So we had various aspects of various scenarios, okay, from full ownership to, partly owned subsidiaries. And then we've looked at, scenario where there is unrealized profit on stock. That was last class. And then we've also looked at minority interest scenario. Okay, of course, that's what we call partly owned subsidiary, basically. And then we have been able to look at post-acquisition and pre-acquisition reserves. Okay, so last class we looked at unrealized profit for on inventory or stock, unrealized profit on inventory or stock. Okay, that's now looked at last class. So in this class we're looking at what we call transfer of assets. That's a scenario where there is transfer of assets. So we're still on group balance sheet, also called consolidated balance sheet. But in this scenario, we're looking at what? Transfer of what? Assets. Now, this asset we're talking about here, we're talking about non-current what? Assets, or we also call fixed assets. Okay, so the transfer here can also mean sale. So we can be saying transfer of assets or sale of assets. So it could be non-current asset or fixed what? Asset. So what we are saying here basically is that the of course there is a holding company as usual or what we call parent company, and then there is a subsidiary. Okay, you already know what that means, right? Now we're saying that there's a possibility that fixed assets, or we call non-current assets or fixed assets, okay, can be transferred or sold from, let's say, from the parent company, okay, to the subsidiary. So what we're saying is that the holding company has an asset, a fixed asset or a non-current asset. Now he's transferring it to the subsidiary. Of course, it can happen that it's from the sub to the holding company as well. But in this case, I'm looking at transfer from the holding company to the subsidiary. Now, don't forget that this fixed asset we're talking about, because you know your fixed asset, your land and building, your furniture and fittings, equipment, plant, and all that. Okay, that will call non-current asset. But here, there are two scenarios. It is possible that the holding company, okay, has the fixed asset as an inventory. Of course, if a company is dealing in fixed asset items, it's an asset, but it's no longer a fixed asset. It becomes an inventory in that scenario. Let's say a company that sells vehicles, for instance. Okay, if you sell vehicles, of course, vehicle is an asset, okay, to a company that is using it to increase productivity. But now, if it is what you're dealing in, if you buy and sell vehicles or you manufacture and sell vehicles, the vehicle is no longer an asset in that sense. I mean, fixed asset now, but it is an inventory or a stock. Of course, stock and fixed asset are all assets, but one is current, the other one is what? Is fixed or non-current. So now your fixed asset items or non-current asset items from the perspective of the subsidiary can be an inventory to the holding company or an asset to the holding company. Okay, so there are two scenarios. It is possible that the holding company is having the asset as an inventory, that is, they manufacture and sell, or they buy and sell the fixed asset. So they are now transferring or selling to the what? To the subsidiary. Okay, so in that scenario, of course, you recall your principle, or what I have taught you on what unrealized profit on what on stock. So that will also come into play here, where you're going to adjust for the what unrealized profit item where you're what consolidating. Of course, the holding company will transfer to the subsidiary at a particular cost, and that cost would have been plus what profit before they transfer to what to the holding to the subsidiary. Subsidiary will not take, but to subsidiary it will be a cost. I already explained that earlier. It will be a cost. Okay, so but then it goes on like that. But at the point of consolidation, you don't expect the what balance sheet to be recording that asset, okay, at what at cost plus profit, because in that case it's as if the what holding company is what selling to itself. So because you're now bringing the subsidiaries inventory, sorry, the subsidiaries asset, that which is the balance sheet, to be one with that of the what holding company, you have to adjust for any unrealized profit element. I've taught that in our previous class. So that can happen on transfer of fixed assets where the holding company is having those assets as an inventory. That is, they buy and sell those asset items, which is fixed assets, okay, or they manufacture and sell. But it's also possible, that's the first thing, but it's also possible that it is an asset to the what to the holding company, normal fixed asset, but they are now transferring it from the holding company to the what to the subsidiary. Maybe the subsidiary needs it, and then they are now selling it to them. Okay, so if you don't need it that much, but subsidiary needs it that much, you can sell to them so they can be using. So in that case, of course, it's a transfer from holding company to the subsidiary, but then there could be what a profit element. So you have to know if there's a profit element on the transfer. So if the company, the holding company, is transferring to the subsidiary at what? A cost plus a particular what profit. Of course, it would be like selling price to the holding company, but to the subsidiary it is what? It is buying price. Okay? But at the point of consolidation, we must eliminate any profit transaction between the holding company and the what? Subsidiary. So I already explained that. So let's say, for instance, holding company, let's say has, furniture and fittings, what, let's say 2,000 naira, in that sense, okay? Now, if holding company now transfers the furniture and fittings to what? Subsidiary, let's say at what? 2,200 naira. Okay? Now, to the holding, to holding, it is selling price. Okay? That's talking about this 2,200. But to subsidiary, it is what? Cost price. So, the subsidiary will report this as the cost of the asset in his own books. But to the holding company, they have sold at what? At a margin. So you can say that it's very simple. You can simply tell that there's a margin or a profit of how much? 2,200 minus 2,000. That's how much? 200 naira. So there's a profit of 200 naira on this what? On this furniture and what? Fittings. So what we're saying is that so long as they are operating and they are reporting separately, there's no issue. But at the point of consolidation, we cannot report the furniture and fitting at 2,200 from the perspective of the subsidiary anymore, because now the subsidiary wants to be one with the what? With the holding company. So remember that the cost as at when they are transferring to the holding company to the subsidiary is 2,000. So we cannot hold that what? That furniture and fitting at 2,200. We have to adjust it back to 2,000 by eliminating for the what? the 200 naira what unrealized profit. Okay, so how do you adjust? Of course, you know that what your assets have debit balances, liabilities have credit balances, expenses have debit balances, incomes have credit balance. So we're talking about assets here. Okay, so now we're saying that the furniture and fitting, which is what an asset, has a debit balance. Now, instead of reporting 2,000, we reported 2,000. So there's an overstatement in that sense. So we have to adjust for it. So what do? We credit what non-current assets, or what we call fixed assets, with 200 naira, which is the unrealized profit item. And then we now debit our what? Our reserve or our profit what and loss here, which is what 200 naira. Of course, you understand what we're saying here. So by so doing, we have adjusted for the what furniture and fitting to eliminate the what profit what item. Now that is for the cost of the asset. But remember that the holding company has transferred to the subsidiary, which they use 2,200. So in the book of the subsidiary is 2,200. Now, even though we have adjusted for the unrealized profit, even though we have eliminated the profit item, remember that the subsidiary would have been depreciating this furniture and fitting, and they would have started going from 2002. So it means that for subsidiary to have been depreciating from 2,200, which is now the new cost, or the cost of the what asset from the perspective of the subsidiary, there must have been an over depreciation. So we have to adjust for what we call over depreciation, because ordinarily you ought to have been depreciating, based on 2,000, but now you're depreciating based on 2,200. So there's an over depreciation. So we need to also adjust for over depreciation before we consolidate. So after adjusting for the what unrealized profit, we have to now adjust for over depreciation. So what do? We have to say, okay, what is the depreciation policy on the furniture and fitting? So let's say it is 10%, which is 0.1. So for us to now calculate over depreciation, we say over depreciation will be what? 0.1 times what is the what unrealized profit? 200. So what's the 10% of 200? I think that's 20 naira. So it means that we have to what adjust for over depreciation. So after adjusting for the unrealized profit on the what fixed asset, we must also adjust for over depreciation. Okay, so we look at the depreciation policy, multiply it by the unrealized profit to get the what over depreciation. Then we not what raise journal for the over depreciation. So for over depreciation, we are now going to say, of course, you know what that means. It means that you have what? You have unnecessarily charged expenses against your what? Your reserve, or against your P&L. Is that what it means? That's what it means. Okay, because depreciation is an expense. So if you overstate depreciation, you understate your profit. Okay? So that also means that you have also what understated your assets. Remember that you report your assets at what? Net book value, which is costs minus accumulated what? Depreciation. So if your depreciation is unnecessarily high, your net value will be what? Low. So what do? For you to adjust for over depreciation, you're going to say debit what? Non-current asset, or the fixed asset you're talking about. You debit it, and then you credit your what? Your reserve. Of course, it is possible that most cases we show the asset items in the balance sheet at what? Net book value, or what we call carrying amount, which is cost minus accumulated depreciation. So for us to adjust at consolidation, we'll take it up against the what? The fixed asset itself. But if you have a way to adjust against the accumulated depreciation, that's also fine. So instead of saying debit net current asset or fixed assets, you can just say debit accumulated what? Depreciation, and then you credit your what? Your reserve with how much? 20 naira. So what it means is that you would have what? Debited your accumulated depreciation between naira before you now take it off your what? Cost of asset to arrive at your net book value, or your what do you call it now? your carrying amount for the what? Asset. Okay? So what I've simply said here is that there's a possibility, there's a scenario where the holding company can transfer fixed assets to the what? Subsidiary. And when the holding company does that, okay, if it's a depreciable fixed asset, now the holding company can transfer at a profit. So to the holding company is selling price, but to the subsidiary it is cost. So they'll take it to their book as cost and they'll start depreciating. But at the point of consolidation, that profit element that the holding company has added when transferring has to be eliminated. So this is the word elimination. Once you get the profit item, like in this instance, the cost of the asset is 2,000, but the transfer at 2,200. At consolidation, we have to eliminate, which is 2,002 minus 2,002 minus 2,000, which is what? 200 naira. So this is the journal entry. You credit your what? Fixed assets, debit your what? Reserve. Now we are saying that because the cost at which the subsidiary is taking that asset, okay, is at a higher what? Value that has been adjusted for. They must have also over depreciated. So we also adjust for over depreciation. So this is the depreciation value or percentage upon this. Once we get it, multiplied by the what? Unrealized profit to get the over depreciation. So here we assume it's 10%. So 10% of the what? Unrealized profit on the what? Fixed asset is what we call over depreciation. We will now adjust for it again, which is to debit accrued depreciation, credit reserve, or debit net current asset or fixed asset and credit what? Your reserve. Okay, so this is just the adjustment you need to do before you now go ahead to what? Consolidate, where you have transfer of what? Fixed assets. Okay, so I'm not going to start doing T's. Every other thing remains the same. Then after doing this, you can now go ahead and open your investment account against your, your share capital, against your pre-acquisition reserve. Then get either you're going to get goodwill on consolidation or reserve, and then you go ahead and open your minority interest and then consolidate. Okay, so I'm not going to open that T here now because I know you already know it. Otherwise, you have to go and take the classes where I have taught on how to use your T format. Okay, so here we'll just go straight towards the consolidated what? Schedule. So take your time, go through the classes. If you have questions, you can reach me on the numbers displayed. I'm there to reply with my answers. Okay, let's take this straightforward question so that we'll have an idea of what we are talking about here. Okay. So what do we have there? We have the full represent the balance sheet of Kings and Queens Limited as at 2018. So we have the asset Kings, Queens. We have land and building, furniture and fittings, equipment, debtors, investment in Queens, inventory. We have cash at bank. Okay. Then we have liability. We have share capital. We have reserve. Okay. Now additional information here. They said that Kings Limited acquired 90% shares in Queens Limited on 31st November 2016 when its reserve was 1,150,000. Okay. Now the inventory of Queens Limited includes inventory worth 1 million naira purchased from Kings Limited. It is the policy of Queens Limited to sell at a profit of 25% on cost, because that's the issue of unrealized profit on inventory. 3. The equipment of Queens Limited includes those worth 2 million naira received from Kings Limited. The cost of the equipment to Kings was 1.5 million. The general policy on equipment is 20%. You see? Now they say you're going to prepare the consolidated schedule and consolidated statement of what? Financial position as at 2018. So here we have a test of everything that we've been doing so far. Okay? Right, so let's go. So we're doing, let's say, this is the consolidated schedule. Okay? So let's call here cost of what? Cost of control. Okay? So I think that's what? K in Q, 90%, right? So here, let's call this minority interest. This is 10%. So let's call this consolidated profit and what? Loss. Okay? So what's the first thing there? Queen's share capital. That's how much. According to the question, Queen's share capital is 100 million. So we have 100,000 here. So 90% here is 90,000. Here is 10,000, right? Now the next thing is reserve. What's Queen's reserve? Now, before I write the reserve, we have to adjust because there's an adjustment here that will affect the reserve. So what's the first thing? They say inventory of Queen's Limited includes 1 million purchased from Queen's Limited. It is the policy of Queen's Limited to sell at profit of 25. So that means that what? That inventory that was purchased from King's has a profit what element. Okay, so they say it's what 1 million. That's King's sold to Queen's at 1 million. So from King's perspective, the selling price. From Queen's perspective, is cost price. But because of consolidation, it becomes a book of the group, which is King. So Kings cannot be selling to you. So they have to adjust for the profit element there. So we know that our cost plus profit is equal to what? Selling price. So here, our cost plus profit. Profit is what? 25%. So that will be plus 0.25C is equal to what is the selling price? 1 million, which is 1,000. Of course, take out the 3 zeros there. So here we have 1C plus this. That will be 1.25C is equal to what? 1,000. So C will be 1,000 over 1.25. So C will be equal to what? So you pick your calculator. So we say 1,000 divided by 1.25. 800. So our cost price here is 800. So what's our profit? Our profit will be equal to what? Selling price minus cost price, which is equal to 1,000 minus 800. So that will be what? That will be equal to 209 or 200,000. In that sense. So basically here now, the profit element on this inventory is 200,000. So let's adjust for it. So what's our journal now? Okay, so that means that what? Inventory has been overstated. So what do? You're going to have to credit your inventory, right? Credit inventory, which is stock, with 200 naira. Then you debit what? Reserve with 200 naira. So that is it for the inventory adjustment. Okay. So what's the next item there? They said that what? The equipment of Queen's Limited includes those worth 2 million received from King's Limited. The cost of the equipment to King's is 1.5. You see? So for equipment now. Number 10. They transferred it to what? Queen's at 2 million. But the cost to King's is 1.5. So that means there's a profit element. So what's the what? Selling price? That will be 2 million. What's the cost price? 1,500,000. So that means profits will be equal to this minus this. That will be 500,000. So we have to adjust for this. So how do we adjust for equipment here? Okay. How do we adjust for equipment? That would be what? Because there's an overstatement basically. It means that the equipment ought to be 1.5, but now it's 2 million. So we have to what? Bring it down. So what do? Credit equipment with 500, debit what? Reserve with what? 500,000. No, 3 zeros here. So that's what we have. Now we've gotten the profit, but they say there's what? Depreciation policy on equipment is 20%. So there's over depreciation. So let's do over depreciation. Over depreciation. So what's over depreciation? That would be what? The depreciation policy there times the unrealized profit. So what you have 20%. So that would be what? 0.2 times how much? 500. So what do we have here? 20% of 500, 10% is 50, 20 will be what? 100. So this will be 100,000, which is 100 naira, right? Right? So that's what it is. So let's take the journal entry for over depreciation. If we have over depreciated, it means we have unnecessarily understated the asset. So what do? Debit equipment, right? With how much? 100,000 naira. Then credit your reserve with 100 naira. So we have done the adjustment for the unrealized profit on the equipment and the over depreciation. We've also done the adjustment for the inventory. So let's show the ledger before we even go ahead to consolidate. What's the first thing there? We have inventory. So we say inventory, which can also mean stock, right? Credit, debit. So inventory has the debit balance. So balance brought forward. From the question, what's the inventory of the subsidiary? 8,000. So we have 8,000. So we're adjusting 200. So we say unrealized profit 200, right? So that means you have a new balance of what? 7,800. 0,000. So balance brought forward is what? 7. It has a new balance for inventory. For the what? Subsidiary. The next one, we have what? Equipment. What's the equipment? From the balance sheet, the equipment is 4,000. So we say balance brought forward 4,000. So there is unrealized profit here. Credit, unrealized profit 500. There's another debit here, which is over depreciation. Over depreciation 100. So what do we have here? 4,000 minus 3,500. That's 4,000 minus that's 3,600. So balance kind of will be 3,600. So we have 0,014,100. So we have a new balance for the equipment now, which is 3,600. So the next one now, our reserve. Let's open our reserve. That's the credit balance. What's the reserve of the subsidiary? 21,150. So we have 21,150. There's a debit here from inventory, right? So we have an of inventory 200. This one. Then there's another debit from what? Equipment. This is inventory, this is equipment. How much? 500. There's a credit from over depreciation, which is what? 100. So what do we have now? We have 21,250 minus 700. 21,250 minus 700. 2550. That's the new balance. So carry down will be 2550. So we have 21,250. 21,250. So the new balance is 2550. So we can go ahead now. This one is 2550, right? So let's go. So reserve 2550. Free. According to the question, they said it is what? 1,150,000. So 3 is 1,150. So if you take that out from this, you get your posts. What's your post according to the question? Your post is 20 550 minus 1150, 19,400. So we have 19,400. So minority interest is 10%. 10% of 2550. What do you have? 0.1 times 2550. 2055. 2055. So here is 2055. Okay? So what is our pre? Our pre here, 90% of the pre, 0.9 times 1150, 1035. 1035. So what are our posts? 90% of what? 19,400. 17,460. So this 0.9 times this, 0.9 times this. So this is 1035. This is 17,460. 0.9 times this is 17. So when you add this, this, and this, it should give you 2550. So let's try. So we have 2055 plus 1035 plus 17,460. That's it. So this is 17,460, right? So any other item there? We've done all the adjustments. So what do we have? So let's go. Net assets acquired. This plus this. 90,000 plus 1035. What do you have? 90,000 plus 1035. 91035. So we have 91035, right? So this one what? 12055. So now we have our what? Investment. What's our investment according to the question? Kings invested in Queens 130. So we have 130 million. So what's the difference? So we have 130,000 minus 91,035. 91,035. 38965. 38965. So this is the goodwill on consolidation. So if you test it, it will be a debit balance good. I've taught you how to do that already. Okay. So what do you have here? This is 12055. Minority interest. Okay, this is minority interest. And then we now have King's reserve. What is the reserve from the question? King's is 104,500. So we have 104,500. So if you add up, what do we have? 104,500 plus 17,460. 121,960. 121,960. So this is your consolidated profit and loss or reserve. So let's say what? Kings and its what? Subsidiaries. Statements of financial position as at 31st December 2018. We have our notes. So we say these are what? Assets. We have non-current. Let's call it note 1. Let's put our note 1 here. So what do we have? Land and building. Land and building. That's 100,000 plus 40,000. Let's just, you can just do the calculation yourself. It's how much? 60 plus 40, that's 100,000. What do we have? Furniture and fittings. We have 40,000 and 25,550. So what do you have? 40,000 plus 25,500. 65,500. What's the next one now? Equipment. Equipment will be what? Group. Holding company is 7,000. That will be 7,000 plus, once the new equipment value here, 3,006. This is the new equipment, 3,006. So 7,000 plus that's 10,600. Let's check. Calculator. 7,000 plus 3,600. 10,600. So that's it for non-current. So add up. So what do you have? 100,000 plus 65,500. 100,000 plus 65,500 plus 10,600. 176,100. 176,100. So say 176,100. So current now. Note 2. What's the note 2? We have debtors. Debtor, according to the question, is 20,000 plus 15. That's 35,000. 35,000. What else do we have? Inventory. Inventory is 13,000 for holding company, but there's a new inventory value here, 7,008. So inventory will be what? 13,000 plus, what do we have here? 7,800. Let's go. 13,000 plus 7,800. 2,800. 2,800. What's the next one there? Cash at bank. That's 34,500 plus 28,650. 34,500. So our cash at bank is 63,150. That's 34,500 plus 28,650. So 63,150. So let's say we have our bank here. 63,150. So another thing there. That's, let's add up. We have 35,000 plus 20,800 plus 63,150. 118,950. 118,950. We have 118,950. So if we add up, let's not forget our goodwill on consolidation, because 38,965. So what are our total assets? We have 176,100 plus 118,950 plus 38,965. 38,965. 334015. 334015. So let's go. Our liabilities now. What do we have? Let's take our reserve. What's the reserve? 121,960. Then what do we have? What's our share capital? Our share capital, according to the question, that's for the holding company, is 200,000. Now, what is our minority interest? What do we have here? 12,055. So let's add up. 121,960 121,960 plus 200,000 plus 12,055 334015 334015. So this is your total liabilities. This is your total assets. So what we've done here today is, to take into consideration, a scenario where there is transfer of assets between the holding company and the subsidiary. So basically, we tested even unrealized profit on inventory. I've taught that already. So go to the previous classes before you come in. So here, this question helped us to, test all we've been doing so far. There is minority interest, there's unrealized profit on inventory, then there's transfer of asset, there's pre and post acquisition reserve. Okay, that's in the group account or consolidated balance sheet that we have prepared. Okay, so you can go through it. If you have questions, you can reach me on the numbers displayed. Let's reply with the right answers. Don't forget, you can support us by paying the account numbers displayed, or simply, sponsor copies of my textbook for free distribution. Thank you, and see you next class.